Today I'd like to share with you some facts, some opinion, and some of the statistical information that I have used to come to some rather interesting conclusions that I think will help you understand market conditions just a little tiny bit better. Let's start first with on the national level. In 2023, there are 1.67 million household formations in the United States, resulting in 17.2 million household formations between 2012 and 2023. In that same time period, there were only 13.4 million households units completed, leaving a shortfall of 3.8 million household units in the United States. In the state of Washington, the Washington Economic Council indicates that in 2023, there was a shortage of 7,175 new housing units created in the state of Washington compared to 2022 and 2021. They're forecasting a 3,641 shortfall in new housing units for 2024. It's not just the golden handcuff issue with the existing home sellers that are keeping them from listing their properties for sale. It's that the new households, including new construction, are not keeping pace with the growth of population and new household formations in the nation, in the state of Washington, and in the Pierce County, King County metro areas. In King County and Pierce County, the net growth in average home prices through 2023 was 3%. The average price per square foot of properties that was sold increased by 6%, and the total number of inventory in those three metro marketplaces declined by just short of 9%. So the bottom line is new construction and the resale marketplace are falling way short of the number of units that are available to house the new household formations that are taking place in the nation, in the state of Washington, and in the Pierce County, King County metro areas. When you have a shortage, you have pricing problems, and it doesn't cause a bubble, it causes a crisis and escalation of prices. At the same time, resale housing and residential home starts are just simply not keeping up with the change in population. The Federal Reserve published a document this last quarter, and the sum total of that document was that the household net worth of a homeowner throughout the entire country was $255,000. The household net worth of the average renter was $6,375, meaning that the households have a net worth, including real estate, that's 40 times that of the average renter. In my opinion, well, it's not my opinion, it's the reality, that inventory is going to stay low. That's going to continue to put pressure on prices. That means that what we're paying for today is going to be somewhat more expensive a year from now and 2 years from now. Interest rates are going to remain high. But it's my opinion that there's an opportunity for us to be making a huge contribution to our customers and clients' development of their own personal wealth if we can stimulate them to make a move now. I call it my buy it now plan. When you look at the interest rate patterns today, let's say that they're just less than 7, 6.9, and everybody would be drooling over residential interest rates that were 5. When you look at the difference between the principal and interest payment on those two different interest rates, the difference is about $600 a month. If you were able to sustain that payment for 20 months, that would be $12,000, maybe $14,000. But if the growth rate over the next 2 years is going to be 5% in appreciation and a year, and the houses are going to go up in value 5% every year, that means that the $500,000 house over that same time period is going to appreciate by 20%. That's $100,000. Now, who wouldn't invest $12,000 or $14,000 to make $100,000 in 20 months? And that's where I think we can do the best job for our customers and clients. And if I'm correct, they're going to think that we're all geniuses. This is a statistic that I've been maintaining since 1972, when I first started to notice that we were having a huge spike in interest rates that was being driven by a recession that was causing the Federal Reserve to move their target interest rates higher in an effort to slow down the rate of inflation. They did that, and as this chart demonstrates, as the Fed rate moves higher, the 30-year fixed rate mortgage moves higher, and the CPI, the Consumer Price Index, moves higher. Each time there's one of these whars is a presidential election year. What's odd is that in every one of these cycles, as we approach or as we get to a presidential election year, that trend reverses itself. It started doing it in 1973, again in 77, again in 81, again in 87, again in 89, again in 93, and again in 2001. What's the common denominator? The common denominator is that there was a change in the political party in that presidential cycle. The indicators of increases have historically been implemented during more liberal policy administrations, and the fiscal conservative administrations have had a reduction in the rate of that interest rate. Moving all the way over to the far side of this chart, each of those cycles, we get to the point where we are today, and we're seeing that in 2021, 2022, 2023, and again in 2024, those trends have all been higher. Now we're at the 2024 election cycle, and if my theory proves out, they should, after the 2004 election cycle, we should see a reduction in the interest rate. We should see a reduction in the 10-year Treasury note from the Federal Reserve. We should see a reduction in the inflation rate, and we should see interest rates be in the 5s.